Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. Thank you for joining me today. For those of you not familiar with the program, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that could affect you and your real estate decisions will be covered here. We dive much further into what's actually taking place in, economically than just, okay, home sales are up, mortgage rates are up or down. We kind of dive into the reasoning behind these things to give you guys, the real information that you need in order to make the tough real estate decisions, whether you should buy or sell or whether you should refinance your home. What mortgage interest rates are doing and where could they potentially go in the foreseeable future. We cover all of these things. And, lately we've had a lot of people writing in questions on the website at realestate360live.com on the Ask a Question button on the right-hand side. And it's been very helpful because, it's always good to be able to have listeners' questions that have questions nationally about what's going on in their markets. And hopefully we can bring some insights to you that you're either not aware of or can't find out there just searching through the web. Joining me on our panel, as he does each and every week, is Louis Camarosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been cited in the media as a real estate industry expert in Forbes, Wall Street Journal, Fox Business, Smart Money, MSN, and numerous others. Louis, how you doing today?
Doing grand, Ryan. How are you?
I'm doing well. So, we've got quite a bit to cover today. Obviously, Janet Yellen, who just took the Fed chairman post beginning of this month, is set to speak. I'm sure that you will agree that she's probably not going to say too much in this initial meeting. She'll probably wait until March to really make her remarks as to, what her plan of attack is, shall we call that. What do you think? Obviously, it's not just Yellen. All the other talking Fed heads are going to be all across the country giving their input. Do you think it's going to be much of the same and everybody kind of giving their differing opinions till we just arrive back at the same place that not much is going to change?
Actually, no, Ryan. I think what we've been seeing is quite odd in the last month or so is a determination by all of the Fed presidents, including Yellen and Bernanke on his way out, that tapering was the right thing to do, and they're going to soldier on. Now, we've always heard from Fisher and the Hawks have been yelling and screaming, we have to stop QE. But now you're seeing Lacker, Rosengarten, you're seeing all of them saying that doesn't matter what happens in the economy, really, if the stock market goes down or if the job report comes in, just 2 months really bad, we're going to continue. They've always said it's data dependent, but even in light of bad data, they're still saying we're going to taper. Now, I find that odd that, they have this kind of visceral attachment now to tapering. Similarly, back in October, the debt ceiling crisis was all over the news because a certain element of the Republican Party felt it was absolutely essential that we stop spending money and we do something to rein in the spending. Well, that's gone away. So what we have now is it looks like the Fed is going to be stopping QE or trying to stop QE or determined to stop QE. And you also have Congress saying we're going to spend away, but even as we spend away, the good news is we're not going to have to worry about defaulting on our debt, which leads me to the conclusion something has happened. And I suspect China has told them, knock off the QE and don't go ahead and put any doubt in our minds that you're not going to pay back the Treasury Securities by not raising the debt ceiling. Because you've seen this concerted effort. You've seen Jack Lew warning on the US Treasury Secretary warning, we have to raise the debt ceiling. You've seen the Republicans cave on the issue. Now, you can say it's because for politics they want to focus on Obamacare to get reelected. But still, if it was such an important emergency to immediately get our financial house in order, you don't just put it off for political reasons, unless there's something else. And then this tapering bit, you're seeing even the biggest doves saying tapering is the right thing, even though the data is coming in in their minds, which would lead them to believe they should do more QE. So I'm kind of confused. Well, not confused, but I'm kind of along the path that we're in a new paradigm, so to speak, where the Fed is going to do whatever it can to try to stop buying mortgage-backed securities and stop buying U.S. Treasuries and still keep interest rates low. Because remember, that's what they said they wanted to do. They think they can do that by keeping interest rates low just because they'll keep the Fed funds rate low. But also they may achieve that because all the money is coming back from the emerging markets, that was there as hot money when the Fed was printing a lot of it. Now it's coming back to the U.S. in the form of a safe haven. And maybe that's where, the buyer of last resort, we used to be the Fed, you get a lot of that safe haven money coming back, keeping interest rates low. I don't know how long that will last when people realize that maybe the U.S. isn't a safe haven, if it just is going to raise the debt ceiling, keep printing. But one thing, Ryan, I've always said about the U.S. ability to print and willingness to print, it does in a perverse way give comfort to bondholders that if they buy bonds, they'll get paid back because the U.S. will print and has proven that it will print in order to pay.
Yeah, I would agree with you there. And, what I also find interesting is that we've had a lot of bad data coming in as far as employment, all these things that can trigger people pulling money out of stocks. And where do they typically go when they're pulling money out of stocks, Louis? They're typically putting them into bonds or mortgage-backed securities or other things. So it is kind of interesting, the dynamic of what's taking place right now. I'm not really sure as to what they're up to either, but it does seem like they've made a massive change as to where they see themselves going in the coming months.
Because the doves are the ones who have really changed their tune.
Right. Yeah, and for them to basically want to consider tapering regardless of what data they have.
I'm not saying regardless of what data, but they've seen two very bad labor reports. And they can't explain them away. And they're saying, just one or two.
That's what I'm saying, though. Regardless of what data's coming in here, they're going to make up a reason, whether it's weather or whatever else, to just disregard those numbers.
Right. They want to stick with their narrative. The economy is proving we did the right thing. We're going to taper.
Yeah, we had unemployment rate that dropped from 6.7% to 6.6%. But, typically the bonds traders have been ignoring that reading because really the only significance to traders right now is that the Fed had set a target of 6.5%.
Right.
So we haven't gotten yet into that level. But once we get to that level, the Fed had already came in and said that they're going to keep interest rates low even after the unemployment rate breaks below that 6.5%. And it kind of brings.
And Ryan, explain what that 6.5% really means, though.
Oh, that 6.5% is basically only taken into consideration the people that they want to count. If we break down the actual numbers, there was a graph that I looked at the other morning of 247 million Americans. We have about 91 million that are not looking for a job. We have 118 million that are employed full-time, so that's 48% of the population. We have 28 million that are employed part-time, and we have 10 million that are physically unemployed, that they're counting as unemployed. Now, a large chunk of that 91 million that's not looking for a job or stopped looking for a job is not being factored into this equation of the unemployment rate, which is
right.
is crap, which is complete crap, because they're basically saying that these are retirees, these are people that are maybe stay-at-home mom or dad, so they don't count. These are people that are no longer looking for work anymore. They've fallen off unemployment, or they've just kind of given up on their job search. But, it was interesting because I think there was an article on CNN Money that broke down all these statistics, and then in one of the sentences had read out something to the effect of, don't be too alarmed. To the discouraged workers, this group also includes people who are retired, enrolled in high school or college, and staying at home to take care of young children or elderly relatives. Now, okay, not to be alarmed, but we only have 48% of the population employed full-time. Is there not a problem with that, Louis?
No, Ryan, there was also the statistic somebody pulled up that if you calculated the unemployment rate the way they calculated during the Great Depression. Now, remember, during the Great Depression, 25% of people were unemployed, and that was considered an economic disaster. They said if you count it the same way they counted it back then, the unemployment rate would be 29% today. And your numbers that you just gave bear that out.
Oh, absolutely. I mean, when you're looking at it, I mean, I would venture to say, Lewis, that 29% number would be right, if not a little bit more than that. Right?
And wouldn't you think, Ryan, then therefore, unless China told us to knock it off, we'd be doing more QE because they think QE is what fixes the economy. They haven't fixed anything. The number of people on food stamps has gone up. The number of total people not working has gone up. The labor participation rate has gone down. So if the economy hasn't improved yet and they think QE is the panacea, they should be doing more of it. But somehow they've got it stuck in their heads now. They're not going to do it anymore. Now, that doesn't make any sense for a Keynesian stacked Federal Reserve to say they're not going to print money and they're not going to try to stimulate the economy anymore.
Yeah, there's definitely more to the story than what's being led on here, and I think that you are probably partially correct with international influences such as China and probably a few other countries that are putting pressure on us to not continue this program.
Otherwise, they'll find alternative ways. You know, there's things going on in the Middle East where China is gaining greater influence. They use the RMB, the Chinese yuan, as a current trading currency for international transactions. You know, the U.S. cannot afford to lose its status as the world's reserve currency for two reasons. We'd have massive inflation, and also if China decided, you know, to stop sending us the products that they send us for really low price, then our cost of living would go higher. So there's a vested interest in keeping the dollar as the world's reserve currency and abusing it, doing trillions of dollars worth of printing money out of thin air to do QE makes, you know, the natives restless, saying, well, why do we need to use this? It's that dollar is, you know, those policies solely benefit the United States because it helps to pay for their welfare warfare state. And, you know, this happened back in the 60s during the breakdown of Bretton Woods when the Germans, the French, and other countries were concerned that the U.S. was ramping up the Great Society under Lyndon Johnson, sending a man to the moon and fighting the Vietnam War, that the U.S. was spending beyond what its gold reserves had. And under Bretton Woods, you were allowed, if you were a central bank country, could come and claim your dollars for gold. So they started doing that. And eventually, that's what caused Nixon to pull the U.S. off the gold standard, because more countries are coming and collecting their gold as they were allowed to do under the agreement. So Nixon got rid of the agreement and took us off the gold standard. And then a few months later, at a G10 meeting, Secretary Treasury John Connolly at the time, Ryan, said, it's our currency, but your problem. And that appears to be kind of the attitude we've had for the last 40 years. And the U.S. was able to get away with it because of its dominance in the world. Right. You really can't tell the Chinese, it's our currency, your problem. They say, no, we own $1 trillion of these in reserves in U.S. Treasuries, and we supply you, you know, with goods.
Yep.
And, you know, back when the United States did that, U.S. was a creditor nation. Now it's the largest debtor nation in the world. So we don't have the same leverage other than militarily.
Yeah.
Economically, it's lost.
Right, and you know the Fed has came out numerous times and said that they've accomplished their objectives, right? Like they've actually done something with
mission accomplished.
Right. Well, you and I both know, and a lot of other people know that the QE has been a massive failure. It hasn't really done anything other than make the rich richer,
and bail out the banks.
And bail out the banks. Yeah,
and allow the U.S. government to continue spending at the low interest rates.
Correct. And as a byproduct of all these things, we have the stock market, which has continued to climb, and that's merely because of the access to free capital, which typically the majority of the rich and the big banks have access to. It's not your everyday average Joes that have access to the capital. So we have that. We have mortgage interest rates, which have stayed low, and a lot of that has to do with, you know, the way that the economic data is coming out. Once again, I'm convinced here. I mean, this is not like a major conspiracy theory or anything, Lewis, but I do feel like the data is pushed out there how the Fed wants it to be pushed out there so that they can really control the interest rate environment. If they don't want a jobs number to come in too hot, then it won't come in too hot. This is not, I don't think, any new news to anybody out there, but this is probably what's going to transpire over the next 2-3 years is just this control controlling the data, never letting things get too out of whack. Now, the stock market, obviously, I feel like it's way overbought at this point, but, what could actually slow it down right now? I mean, it seems that there's so much international fears taking place that, like you said, the U.S. is becoming the safe haven for foreign investors. As long as that takes place, we can keep a low interest rate environment and expect much of the same for the coming years. With the fact that we have so much of our economy and the people that live here receiving handouts or entitlements. At this point in time, what are the odds that we actually see any sort of shift, even at the next presidential election, or is this just going to be a continuation of this failed policy moving forward to the next 4 years?
Ryan, I'll give you an example. Not just the people that are receiving direct benefits, and that crosses the entire socioeconomic spectrum. It's not just poor welfare recipients. You got food stamps and you have welfare. But then you have your baby boomers with their Medicare, their Social Security. Then you have corporations who rely on subsidies, tax breaks, and so on. But then you also have 65% of Americans own homes, or somewhere around there, 60 to 65%. And I've spoken to many of them, and they really don't care what the Fed is doing as long as what they're doing is making the value of their home go higher. Now, a lot of the people that I've spoken to are amongst the 25 to 40%, depending how you calculate what underwater means, are underwater homeowners that were forced into that situation because they bought a home based on the failed policies of Greenspan and Bernanke, which kind of got them in over their heads when the last housing bubble went bust. Now they're captive to the Fed because they want the Fed to get them out of the trouble, to bail them out and push home prices higher. And they see that happening and they say, hey, be quiet, shut up, there's a recovery going on, it's a good thing. And you try to explain to them, well, it's a recovery in price only, and they're like, well, that's all I care about, it's price. Right. And they don't care that and I don't know if you saw it, but on the smaller.com, I printed a chart that showed home sales over the last 20 some odd years. And, they peaked in around, 2005, 2006 at a very high level. Then they fell off the table all the way down to 2009. And gradually they started moving back up to, levels seen in the early 2000s. However, the homes purchased by first-time homebuyers and people taking out mortgages during that time period has dropped to levels last seen, in the 60s and 70s.
Yeah, which means the first-time homebuyer in 2013 was, 27%?
Right, 27% of a number that's pretty low, even though it's gone up in the last 3 or 4 years. It's still far off from its peak in 2005. Now, homeowners don't care about that. They think the housing recovery, and that's what the media keeps telling everybody, isn't about price. It's about price. It's not about how many homes are sold, how many new homes are built. New home construction, I put a second chart on that blog post that showed the number of new homes bought in the last built in the last 3 to 5 years, again, is at all-time historic lows dating back to the 60s and 70s when the population was 26 to 37% lower than it is today. So we are in a massive depression in terms of the real estate industry, except they're trying to move prices back up to where they once were, and that's all people care about. So you have people reliant upon either their subsistence in the terms of welfare or their benefits or corporations or people's homes, values going up, dependent upon government action and Fed action. And as long as they're somewhat aligned in their interest, the Fed can go on looting and paying its shareholders and bailing out the banks as long as they're throwing crumbs to homeowners.
Correct.
And as long as people continue to get their benefits.
With that. Yeah, and I agree with you 100% because of all, the clients that I talk to, it's all, they're very happy that their home prices are up. They're happy that their stock portfolios are up. But nobody seems to understand that this would all be fine and dandy if we had jobs being created all over the place, if we had rising wages. It would give us good reason to see all these things moving in a positive direction. But that's just not what's happening. I believe it was Barclays just cut, 12,000 jobs? 12,000 That's not a small chunk of change. Now, granted, it's over in the UK, but there's many other international jobs. These things typically have a way of playing themselves out. I mean, there's been many banks that have been getting rid of many of their people in their mortgage departments because there's not as many people that are able to do anything refinance-wise, so it's only driven by purchase transactions. You and I discussed on our last show. You guys weren't able to check that out. You guys can go to the iTunes store and search Real Estate 360 in the search and download our previous shows. But we had talked, in depth about these jobs that are not available for people. And there's an article, Lewis, that I thought was quite telling. It's I believe the blog was Keeping Current Matters. Now, this blog is mainly set up to be able to funnel information out to real estate agents, right? And they send articles each and every week, and they're always and they want you to subscribe to a premium service, which they're going to give you free reports and all these things that you can really use to sell potential sellers or buyers as to why it's a good time to buy or sell in this market, right? So one of the last articles that was written was "Be Quiet, Chicken Little, the Sky is Not Falling." That was the heading of this article, and it kind of goes into talking about there had been speculation about what was causing the falling sales numbers on all these recent existing home sales reports that is provided by the National Association of Realtors. And they broke it down into some that have claimed that rising interest rates have scared buyers out of the market, and others that have claimed that consumers were just losing confidence in the housing recovery due to that there was a fear of a new bubble that may be forming.
Well, so they can't afford it or they don't have a job.
Right. Well, and for the mortgage interest rates, they made the assumption rising interest rates have forced buyers back into the fence, evidence offered up by those in the camps come directly from EHS report from NAR. And then they said in the article, the reality is that, yes, there was a true year-over-year sales have fallen nationally. A closer look at the report unveils major regional differences. Sales in the West region are down 10.7% versus the same month last year. Sales in the Midwest region are also down, but by less than 1%. The Northeast is up 3.2%, and the Southern region is up 4.6%. So if the issue is interest rates, why is one region virtually unchanged and two of the remaining three regions up in sales? We don't believe the rates are the challenge. Now, obviously, when you start talking regionally across the country, would you not agree with me, Lewis, that the job situation is going to be completely different in one area versus another?
Totally different. And in fact,
absolutely.
that impacts whether people can buy homes or not, easily. And that impacts home prices. The unemployment rate is very low in Silicon Valley. Incomes are high, so prices are high. And also, Ryan, in the last year, the first-time home buyer percentage has gone, a few years ago it was 40%. That's the historic number. Then it went down to 30%. Last December 13, it was 27%. So the number of people entering the market to buy homes through traditional mortgage means is declining, and you're seeing a fall-off in investor interest. That's why home sales are down, but they're down even more amongst what has traditionally sustained the housing market. And that's what I put in the blog post, Why the Housing Recovery is a Farce. That's the title of the blog post if you want to look it up.
Yeah, and I definitely read that article. It's a great article for our listeners to take a look at. Now, and these numbers shouldn't really scare you if you're in a position today where you've got a stable job, you have the income, you're able to take out a mortgage. Because remember, guys,
that's the paradox. It is a good time to buy if you have the money and you have the access to that 30-year mortgage.
Right, and don't get caught up in what the Fed and Congress and everybody else is peddling, which is, price is the only important thing here. Price is not the only important thing here, because I'm telling you that if you could obtain a mortgage at somewhere around 4% or sub 4% right now, I don't care what happens to the price of homes. You're protecting yourself for a 30-year period. Now, there can be ebbs and flows. You're going to have property values shoot up and come back down and be all over the place, especially with the policies that we have in place.
Let's call it rent control.
Exactly.
You're buying a mortgage and you're fixing your rent for the next 30 years.
Absolutely. So even if, we lose 50% of our equity, your payment is still going to stay the same for 30-plus years.
Right.
And, and I think that everybody's like, well, I don't want to buy and lose 50% of my equity. Well, it's not a guarantee that that's going to happen.
No, if you have inflation, the nominal amount of your house will go up too.
Right. And so, these asset bubbles are created all over the place, and we have huge spikes, and then we'll be brought back down to earth when, just like the stock market will be brought back down to earth at some point where the levels that they're at right now are not sustainable. And, if you're a person that's out there, like I said, it doesn't matter that prices or whether they continue to rise this year or next year or the year after that. If you're able to secure a 30-year fixed mortgage at the rates that they're at right now, you should definitely say to yourself that it's a great time to buy. Now, if you don't have a job and you don't have money saved up for a down payment and you're wondering, where your next dollar's coming from, then yes, I mean, you're probably not going to be in a position to buy nor take advantage of low interest rates. But at that point, price shouldn't matter to you at all anyway. Right?
Brian, what they've done in the last 15, 20 years through all this manipulation and trying to force housing, and it started back in the 30s. It's not like pushing housing by the government is a new thing. They really went into overdrive when even Krugman said at the end of the right after 9/11, the Fed needs to blow up another bubble, should be a housing bubble, that people have got it in their heads that buying a home has a primary component of price appreciation when the price appreciation used to just be a little icing on the cake for somebody who wanted to purchase a home, have pride of home ownership, move their family in there, and so on. Now it becomes, I'm sure you get it all the time when people are talking to you, when you're advising them on the type of mortgages to take, they're always asking you about, what do you think it's going to go up? Do you think this area is going to go up? That's all they seem to be concerned about, rather than what should be the primary reason to own a primary residence is, do you like the house and can you afford it and you're going to live there for a while? And is it worth it to you to purchase this asset, not this investment that you're going to flip and make money in a few years and take out equity? Because a lot of them are looking at it, if it goes up $100,000, I can extract some cash out of that.
Oh, I can't tell you how many times I've had that conversation. Well, do you think that this home value is going to come up? Because I feel like if we get this at the price that it's at right here, maybe in a year from now, we'll be able to get a home equity line and go in and maybe finish the basement or do whatever, they want to do to the home. But, right. I mean, trying to predict, where things are going is a recipe for disaster. I mean, and whenever I'm talking with clients and their main focus is equity position in a home, I tell them, that I may not be the best fit for them because I'm not going to be the guy that has, mud on my face from where values took a turn for the worse, and it was only because they bought that house where they were trying to buy it as an investment property and make money off of it, right? Because that's a completely different animal. If somebody comes to me and says, hey, Ryan, I want to buy an investment property, and my sole goal is to be able to turn this money over and make 10 or 15 or 20% on my money in 6 to 12 months. That's a completely different scenario.
That's a different person. That's a different investment. That's not even investment. That is an investment, and that's how you should look at it, whether you're going to rent it for a period of time or you're going to flip it. But buying a house to live in and then trying to it's like trying to live inside your stock. You can't do it. You're either an investor or you're a homeowner and you live there.
Correct. And so
you got to take care of it, but the idea that it's going to go up and you're going to sell it, most people aren't even going to do that. They're looking for the home equity to take money out because then they're just going to drag their family out and go move. I did see that in Los Angeles, though, the Los Angeles area in the 2000s, where people would move every year and they would move up because the housing prices were going up so much.
Yeah.
But that's not realistic today.
Well, no, and that happened in Northern Virginia as well, where people would just kept moving and stripping equity out of each house that they sold. At some point, though, they got caught, right?
Oh, yeah. I saw people that were making $30,000, $40,000. They bought starter homes in, the $200,000 range. And by the end of the bubble, they were living in $900,000 homes. Yeah. And then they couldn't pay for them.
Exactly. Then the values went back on them, and they couldn't refinance and continue making their payments, and they were pretty much done at that point. So I think that, back to that article that I said, one of their things, their reasoning for a lack of sales, it's not the result of increasing interest rate or decreasing consumer confidence. That's not what actually is happening, and they summed it all up by 3 words. It's the lack of inventory. Well, my reasoning in my 3 words is the lack of jobs, right? A lack of full-time jobs, a lack of full-time work is really the reason. Because think about it. even if we have this price appreciation, Louis, even if we continue down this path, people that have equity in their house right now that don't have stable jobs are not in a position to sell their house. Right? Okay, great. So if a person that's got $100,000 equity just got either laid off or went to a part-time position, so they've got a mortgage on that house that they can maybe make ends meet right now. If they sell that house and take their $100,000 and he still, doesn't have a job. So
they can't get another mortgage.
Correct. They can't get another mortgage. So what are they going to do? They're going to go and try and rent. So maybe what they're going to do is, okay, they could prepay their rent or something because they might not qualify still because he doesn't have a job. So
right.
How many people are actually going to risk doing that? They're not. They're going to keep themselves in the stable position. Now, there might be a percentage of people that do that.
Sure, that keeps inventory levels down. Also, home builders know, because there's not a robust demand, they're not building homes. They're building at a third of the rate they built 6, 7, 8 years ago.
Correct.
Low inventory based on, not just low inventory based on low inventory, it's connected and tied to, as you're pointing out, the job situation.
Exactly. I mean, and that's where I honestly feel like this entire situation.
They keep saying if we just get more inventory. Yeah, you'll get more inventory if people get more jobs.
Yeah, because
if the economy improves, they're trying to disconnect the housing market to the rest of the economy.
Do you feel more confident when you actually have a full-time job or when your house value is rising?
Well, ideally both, but when you pick the full-time job. And that's why people cling to this myth of the housing recovery, because many of them are in precarious financial positions, other than the fact at least their house is going up.
Right. I mean, I would say that if somebody told me that, okay, hey, you have $100,000 equity in your property right now if you sell, and then, on the flip side, somebody comes to me and says, hey, I have a $50,000 per year job that, you can take tomorrow, and you don't have a job, you're
and it's fairly guaranteed as long as you don't screw up.
Correct.
Then you would take that. I would.
Absolutely. I take it all day long. And the fact that, that's really not what's taking place right now. We have that rising stock, so people's 401ks, retirement accounts, and home values are all rising, which gives, makes sense. And the media can continue to pump this notion that everything is moving in the right direction. You know what? Stock portfolios and the home prices are moving in the right direction, but we don't have the actual underlying labor force that we need to support this.
Right. I made the point in another blog post that if you rely on rising home prices and rising stock prices manipulated by QE, and that's what you base the recovery on, well, then the recovery ends the minute, if you've done nothing else other than inflate asset prices, the recovery ends quick, fast, and in a hurry when the stock market collapses and housing prices go down.
Oh, that is 100% the case, and
that's what they've set it up like that. It's a house of cards, and it looks fine, but when it collapses, there's nothing holding up the economy. We haven't built productive capacity. There's no jobs, and the stock market is really being driven highest by unprofitable companies, and that's a bad sign. I love Twitter, but the fact that it doesn't make any money and the stock price keeps going higher means that when it collapses, Twitter's going to lay off a lot of people. Any of these types of companies that make no money, that's the first thing they do is when their stock market collapses, they got to lay off people.
Right. Yeah.
Well, that affects housing prices. So what they've done, they've made it worse. Money has gone into, because that's where the money is, people are willing to pay in this environment high multiples on minimal revenue and no profits. Well, when that goes away, those companies have to find a way to make money or they go under. Now, a lot of them have managed to stick in business and will be around forever because their IPO gave them so much money.
Right.
So they have operating expenses. But they're not going to drive the economy if they don't make money, because real jobs, long-term jobs, are created by companies that have cash flow positive balance sheets, where money is coming in so they can pay employees, not where the stock market price is high and they have cash, on the balance sheet because they did an IPO, because they can run that right down.
Oh, absolutely. I mean, under the logic of that article, they would venture to say that this spring there's going to be a huge influx to the inventory. Now, I do agree partly that there will be an influx of homes on the market in the spring, but that's naturally what occurs every spring.
Right. The question is year over year, will the comparables be better or worse than last year? And they might be better because they were so bad last year in terms of
well, I think that, you know what, especially in my area, in the Northern Virginia area, they will be much better because, you know what, we do have, it's not a fantastic job market because a lot of people are losing their job, but we do have better job market than probably many regions of the country, right? So,
and you have higher home prices, which means some people are out from underwater and they're going to sell.
Right, and I think that that's going to be. I think that that's the biggest component to this spring is that the people that were underwater. Let's just call it. Maybe 20% of those people that were underwater are now above water and can now get out of that property and potentially buy. A lot of the consumers and clients that I'm talking to lately are all people that have been already through a short sale. They've been waiting 2 years and been renting and saving up money for a down payment. So there are going to be some buyers. And see, that's more of the thing where I drive back to jobs, because if jobs were really here, we would have, I think, a ton of inventory, right? If jobs were really present, all the people, because many people do have equity in their properties now, but with them unsure about their financial situation, they're not necessarily going to put their house on the market and move to a bigger home to afford a higher.
Right. What is your experience, if you know off the top of your head or just anecdotally, with the first-time home buyer in the D.C. metro area?
Who is the first-time home buyer?
Well, no, in terms of your percentage business and how many of the first-time home buyers, millennials, you're seeing.
Well, majority of my clients are actually people that have already owned a home and looking to buy another one, right?
Mm-hmm.
I would say that first-time home buyer market is relatively small. I would venture to say it's probably somewhere around that 25-30% mark, or pretty much right in line with your chart.
I would have thought it would be lower in the D.C. metro area because it's more expensive.
Well, there's still pockets, Louis, of, condos and some low-end properties that you can find. You have to be willing to commute further, right? So the jobs, let's say they're all located in the city or, Northern Virginia, D.C. area. The crazy part about Northern Virginia is you can pretty much get to anything in 30 minutes, right? 30 to 45 minutes. So it allows for people to sprawl out further to the west, further to the south, away from the city. They can afford their house there. Now they have to sacrifice because they're going to have a hectic commute each and every day, right? But if people want to buy, that's typically the option that they choose. They move west or they move south. Now,
and the federal government is still hiring, right? They haven't cut back like some of the state governments and local governments, so millennials can get those jobs.
Yeah, they can get those jobs. I mean, the biggest cuts that I've seen has been actually on the government contractor level. Is the ones that have been stripped away. I mean, they put those contracts on hold or just completely cut those contracts. But if you're just talking about your state and federal governments, I mean, they're still hiring. They'll never stop hiring. And as long as
Detroit stopped hiring.
Detroit did stop hiring, and if you notice, somehow did you see a lot of the articles in Detroit that the housing is rebounding there in Detroit? Have you seen
sure. Well, my wife watches a show where they rehab the houses in Detroit. It was the Beatles' 50th anniversary when they came on Ed Sullivan. It was kind of ironic. Back then, in 1964, Detroit was one of the richest cities. It was one of the most, it was held up as an example of the massive power of the United States commerce. And one of the interviewers asked him a question, Paul McCartney, a question about, there's this campaign to stamp out the Beatles. And he said, we'll go to campaign to stamp out Detroit. Well, I guess it worked because, Detroit, the reason he said that, it wasn't like we're going to stamp out some minor little two-bit place. Detroit was a big deal back then. And it's amazing how it's nothing now. It's a wasteland.
Well, do you know the irony behind all this? I bet you could venture to figure out who is going to be the one that's buying up all these city blocks and houses there. The hedge funds, right?
Of course.
That's exactly, and it's funny, I just got an email yesterday from a woman that was starting a hedge fund. She's located here in Northern Virginia, and she's getting everything stuff together. They're looking to buy unsecuritized mortgage pools as well as real estate flips. I almost wanted to say you're a little late to the game. I almost wanted to tell her that, right? Because good luck in getting these big pools at the percentage discount that you think you're going to get them at. You know what I mean? Because I just basically asked her, hey, what are the specifics that you're looking for? And she's telling me 50% loan to values, and I'm just like, you're not going to find that. We're looking at foreclosures that are selling at 95% of what retail value is, in some cases 100% of retail value. There's not the same deals today that there were a couple years ago. But that's not going to stop. What's happening is that the rich have more capital. They're looking to put their money somewhere. And it's interesting because it seems like everybody's in the same boat as that put it into hard assets such as real estate, right?
But did you see Ryan recently did a special on these millionaire, now they call billionaire row homes in London, the Bishop's Avenue, where billionaires have, because they want to park their money somewhere, have bought these 30, 50, 60, $80 million homes on this street and have let them go into a state of disrepair. They've held them for 5, 6, 7 years. No one lives there. And they're just looking to park their cash. And it really highlights how so many people have so much money. They've been gifted this money. And, like if they may have worked for it, but I'm saying is the investment gains that they've made are so large, they just can't manage all of their investments. So they buy properties and they just dump it there. And I guess suppose someone made the point that, if you had $30 million and you try to apply gold with it, well, your storage fees would be a few $100,000 a year. This way you buy a house, you pay the council tax, and it's a lot cheaper just to store your money there. That just shows that you either invest in speculative assets or hard assets, but even hard assets have you have to maintain them. There's a storage component or a maintenance component.
Well, and Louis, what the other fact is, too, if you didn't really trust the banking system, right, would you want $30 million sitting in your bank account?
Oh, absolutely not. And there was that story of the Harvard economist who had $1 million and in Bank of America, and he wrote an op-ed, and he said he's taking it out. Now, I don't know why he has $1 million in the first place in Bank of America, earning no interest. Forget the safety of it, but,
you didn't say he was a Harvard professor, right?
Harvard economics professor. And I was wondering how a Harvard economics professor amasses $1 million in the first place. Well, that's none of my business. But the second time is if he's an economist, why is he having it in a bank account where he knows that it's not insured and he's not getting any interest?
Yeah.
It might have been a PR stunt. Who knows? But the point was, he made a very valid point is, even if the risk is low, the risk is there, and there's no upside to having your money there.
Well, I've always kind of said, and my major in college was business economics, and I always disputed most of which my professors told me, right? Because everything was just straight by the book. They never wanted to actually look at what was actually taking place in the economy. It was whatever the numbers that spit out told them. You know what I mean?
And then whatever theory they decide to wrap around those numbers. That's the real danger in the people that are in the Fed is that they're all just full, lifetime academics. They never worked, never had a job, never hired people. But they know how the economy works. And the reason they know how the economy works is, to them, the economy isn't the free market. It's how they can interfere with it and how they can justify it by a formula or something Keynes said.
Yeah, I agree with you. Just recently, I got a phone call from it's funny we're talking about this. I got a phone call from one of my ex-economics professors, and he was like, "Hey, Ryan, David Bratt here." And I'm like, hey, Dave, how you doing? What's going on?
Did you have him on a show once a few years ago?
Yeah, I actually did. Okay, so funny
I remember
story,
that.
Louis. Yeah, so I had him on the show. So he called me out of the clear blue. He's like, "Did you hear the news?" And I was like, "No, I didn't hear the news." He's like, "Hey, I'm all over the Huffington Post. They selected me to run in the primary elections against Eric Cantor, the congressman, right?" So I was like, "Well, how did all this come about?" He was like, it's crazy. I don't even really know how it came about. Just one day they started talking about it. The next day I'm on Huffington Post, and then the day after that I got a campaign going. I mean, and literally I'm thinking to myself, okay, so this is literally how people just get picked. Now, he did have some ties in with like BB&T, the CEO there, and was on some special committees. It's all about the hidden agendas that these people are looking to push, and it's all about the next media story, right? Now, I'm thinking to myself, once again, they feel like, he's a good candidate because he's an economics professor. But at the end of the day, I mean, I don't know. I'd rather have a business person that has run a physical business versus an economist. And it's nothing against my economics professor, but I just know that there's a big difference between the two. And, you know, if our country was run by a group of businessmen, I think we'd be in a lot better position than a group of politicians. Would you agree?
The problem with politicians are the only way they can make money is by promising stuff. I mean, the only way they can get votes is by promising stuff, and the only way they can pay for it is by taking it from somebody else, so they have to come up with increasing number of tax schemes and so on. Basically, a politician is a redistributor of the wealth. Well, it depends on who his voters and clients are, but basically, if he promises something, it's not like he goes out and works for it. He finds the money somewhere. And people don't care where it came from, as long as your congressman or whoever it is, your elected representative, comes back with the booty, you vote him in again.
Well, and then not to mention they get all the other hidden benefits, which is, if you remember, having all that basically inside knowledge as to what's going to take place with different companies. And
they're allowed to vote on it. I mean, not to vote, to trade on inside information. It's outrageous.
Crazy. Yeah, it's outrageous. I mean, there's just so many, you know, double standards that take place that they're able to. I mean, if you're a politician, it should be virtually impossible for you to go bankrupt, right?
Right. Well, the purpose of a politician originally under the Founding Fathers were it was a sacrifice, it was public service, and they hoped you did it. It wasn't supposed to be a place to set yourself up for life because you went and worked in public service. You're supposed to go represent your district and then go back and tend to your farm or your barbershop, whatever other job you had. It wasn't meant to be a full-time power broker job where you made money off of it.
Yeah, and well, I mean, imagine if they were actually in office and they couldn't actually take an income unless they actually met their budget or actually had a budget that didn't require us going negative, right?
Which is how a business works. Business goes out of business, right? And its executives don't get paid or they get fired if they don't make money.
But they wouldn't have, you know, the interesting part about that is, Louis, the government wouldn't have control if that was the case, right?
No, so it's not supposed to have control. The people are supposed to have control of the government, not the government have control of the people.
I agree with you, but they want to be in control of the people. This is
of course. Look at the NSA. Not one congressman ran on a platform that we're going to spy on you and we're going to increase these spying capabilities and we're going to make sure that nothing you do isn't known by us. No one ran on that, but yet that's what they put in place.
Right.
Well, it's actually worse than that because the politicians, a lot of them don't even know what's going on. They've created these agencies years ago that have just run amok with very little congressional oversight. Yeah, and this is the plausible deniability. You know, that was the original with the CIA. You know, let them go do stuff. We don't know anything about it. But that's gotten much bigger than just the CIA.
And then the way that they can justify it is it's for the public safety of the American people.
Correct, and that is what you elected me to go is to protect your safety.
Yeah,
we didn't say how we were going to do it because we can't tell you. It's for your own good.
Yeah, well, I mean, you know, it's interesting. I wanted to touch on one more thing today before we come to the end of the show. So I've got a couple questions from a couple different people. Many people all in a little bit of the same situations where they're coming out of foreclosures and bankruptcies and trying to figure out, you know, what their timeline is from essentially being able to buy again. So let's say, you know, many people have either had their home go through a short sale or a foreclosure or a bankruptcy. Let's start with the bankruptcy. So the bankruptcy, you basically are able to buy again 2 years from the bankruptcy discharge date. Now,
that's new, isn't it?
Well, no, it's been around. Now, that's only for one specific type of, or actually two types of loans, right? An FHA or a VA loan, okay? So 2 years from bankruptcy discharge date, you are eligible to have another one of those type of loans. Now, it's not just as simple as being able to have it 2 years from the discharge date. You still have to have reestablished credit since that bankruptcy and been perfect and on time ever since that bankruptcy. So if you went through it, you need to probably establish a secured credit card so you can reestablish some positive credit rating from the time that the bankruptcy was discharged. Now, remember, I keep saying discharge date. So there's a file date when you file that bankruptcy. It's not from that date. It's from the time that that bankruptcy actually gets discharged from the court.
Typically, how long is that?
Well, it depends. It's really on a state-by-state basis, Louis. It can be all over the map. Like here in Northern Virginia, they can happen somewhat quick. It can be a couple of 3 to 6 months sometimes. You know what I mean?
Right, but isn't bankruptcy law federal? You're just talking about how quickly the state courts get through it?
I'm saying, how long it's going to take to get through the state court system for the most part. You know what I mean?
I guess it's the federal court in the state.
Correct. So it just really depends on the timing of pushing stuff through. But most of the time I've seen anywhere, 3 to 6 months seems to be somewhat the norm. So once your bankruptcy gets discharged by the court system, that's going to then get sent to the credit bureaus. It's going to show what your bankruptcy discharge date. Key thing is you want to make sure that those dates that they report on your credit report actually match up to the paperwork that you have.
Right.
Because I've seen that there's been varying dates on those, and you want to get those lined up. As long as you have the documentation, you can get that corrected very easily. So 2 years from that discharge date, reestablish credit history from the date of the bankruptcy. Remember, you can't have any lates after that bankruptcy, or they'll deny that loan probably immediately. Now, I'm not the underwriter, but I just kind of, if they're going to look for a reason to deny a loan if you had a bankruptcy 2 years ago, right? So you can't give them any reasons to. So if you reestablish some credit, maybe you could become an authorized user of another person's account, a spouse or a family member or something like that. Also get a secure credit card, and then probably have positive rental history that you can document via canceled checks. If it's a private landlord, a lot of the time they get kind of suspect about things, so it's always good for you guys to write checks so there's some sort of documentation. If you're paying your landlord in cash, that could be a bit of an issue. You know what I mean? Because it's just very hard to trace when you were making payments. And if that landlord is a private landlord, they might say, well, hey, that could be a potential relative or somebody just trying to help you out.
Right.
So you won't need the documentation there. So, but 2 years removed from that bankruptcy discharge date, you can potentially get an FHA loan or a VA, a veteran loan if you're in the military. So that can happen pretty easily. I mean, you figure 2 years is not that long to wait, Lewis. You go through a bankruptcy, and literally 2 years later, you could be in another house.
And is there any? I know under the bankruptcy law, they're not allowed by the law to use that against you, to be prejudiced against you. But do lenders kind of find another reason to not give you the loan because they see that bankruptcy?
Well, for the most part, most of these loans are sent through an automated underwriting system, right?
Uh-huh.
So if it makes its way through that automating underwriting system with what's given like an approve eligible, so if it approves it and that loan is eligible, and the person
it takes that personal kind of element out of it, judgment.
Exactly, right. So then if it meets that criteria, it obviously still has to be reviewed by a physical underwriter. So she's going to make sure that there's no funny business going on with assets or income, and the qualifying ratios are within the range that they should be.
Right.
But if they meet all that criteria, then they're not going to be discriminated against. They're only going to be discriminated against based upon their credit profile and how they've managed their finances since that bankruptcy, right? So as long as they've proven that they have gotten back on their feet and they've showed that through their credit profile and also their income, their job stability, because, in many instances of a lot of the cases that I hear through these bankruptcy situations, when they're going through short sale or foreclosure, a lot of the time these people are getting forced into bankruptcy, right? They're getting forced into bankruptcy anyway. So, but in other circumstances, it's somebody that's going through a health, they end up in the hospital and all of a sudden they got $100,000 in medical bills. Right? These are the common things that I see pop up all the time. So it's not necessarily, I tell people all the time, it's not necessarily the end of the world when you have to go through a bankruptcy. It typically gives you that clean slate. Now, obviously, the bankruptcy laws changed quite a bit since, 10, 15 years ago. Now, there's income restrictions. Many people won't qualify for a Chapter 7 bankruptcy just because of the income restrictions. And if you can't qualify for that, then you'd have to go through a Chapter 13, which would make you actually have to work through that debt. So it really is going to depend. If you're only making, let's just say, $60,000, $70,000 a year, then you have a better chance of getting through a Chapter 7. But the key thing that I want to mention is that when you're going through that bankruptcy and you do have plans down the road to figure out to potentially buy a house again, you need to start working on it immediately. Don't bury your head in the sand and say, "Oh, my financial life is over right after that bankruptcy." It's not. It's actually just starting because you're getting ready to get a.
Well, that's the purpose of bankruptcy.
Exactly. I mean, how many times has Donald Trump went bankrupt? And then
he didn't. His companies did, but you're right. That's right.
Right. His companies have been bankrupt, and he just start back over again. So it's the same thing with a potential person that's going through the same thing is getting a clean slate. Don't bury your head in the sand and just say it's over because the bankruptcy is over. You need to now start reestablishing credit. And if you do that, within 2 years, you could potentially buy a home again. Now, that doesn't necessarily mean you're going to have saved up enough money for down payment. And there's obviously two other things involved, but you can get back on your feet. And I always suggest people reaching out to a mortgage professional to start leading them in the right direction because, I mean, to me, there's nothing better than being able to turn yourself around in that quick of a time frame if you're taking the steps to do that. All you have to do, like I said, reach out to a mortgage professional. If you don't have one, you can contact me. I'll put you in contact with the mortgage professionals that I use each and every day. And you might need some credit repair. We can also put you in touch with those people. Coming up on the end of the show, Louis, I want to thank you again for coming on.
Thanks for having me.
Would you please give our listeners your blog, spell it out for them so they can check out your blog posts that you do weekly?
Sure. It's smaugled.com, SMAULGLD, smaugled.com. If you go there and there's economic news, analysis on the real estate market, gold and silver, and we also post the shows on YouTube directly onto the site there as well. So check it out at smaugled.com.
Thanks, Louis. I appreciate it.
Thanks, Ryan.
Thank you guys for tuning in. Like I said, if you'd like to download the show through iTunes, just search for Real Estate 360 in the search button on iTunes. Download it to your MP3 player or Apple device. Outside of that, you can also stream it on our website at realestate360live.com. We'll talk to you next week, guys. Take care.